Hello, everybody. Thank you for joining. It's Sunday and it's Q&A time. Today, we're going to talk about a whole bunch of different things. And let me make sure I've got my audio. Thank you, Shoni and TND and KH for being here as well. Let me get my bearing. Yes, I think we have sound. I hope we have sound. Today, we'll talk about the miracle of compounding once again and how a very small allocation can have a huge difference, but also how allocation is the edge. A lot of confusion around how to allocate in today's market. And related to that, too, is how disruption is eating the world, but it's also an opportunity, but you got to be on the right side and not on the wrong side. And finally, why it's important to be patient, because there's always a trade to be had. Let's get into it. This one's called Compounding Miracle. And disclaimer, not financial advice. We'll also look at some new stocks, too. And all the questions come from Patreon. By the way, every week, the temperature of the room is very different. And the questions typically have gone from asking all about Bitcoin and crypto to now all about AI and disruption, literally in the space of a few months. So we answer the questions that are most prominent and top of people's minds. So bear that in mind. Let's get into it. Very first question is from the Milkman. I've been using your retire on model and the numbers look insane. I'm 25 and I live in Eastern Europe. I don't have much buying power because of it and only have a tiny bag of Tesla, just 24 shares. Even with conservative inputs like $20,000 a year to live, in 2045 retirement, 23% CAGR, 10% inflation, cautious projections, it shows retirement basically guaranteed. Maybe even enough for a small Thailand holiday home later. Am I missing something obvious, or is this actually realistic with the long timeline and expense? So this is such an important thing, especially for somebody so young. You know, you're 25, you're looking at retirement 20 years out at 2045. The edge you have to be in the right assets early and to be able to wait for 2 decades can be very life-changing. And this all relates to this fellow, Mr. Albert Einstein. He said, compound interest is the 8th wonder of the world. He or she who understands it earns it. He who doesn't pays it. And I've done so many videos on CAGR, compound interest, compound annual growth rate. It's so critical to know. And that's why the retirement model has been built as well. Let's look at an old example, Costco. There's like a retailer, grocery store, etc. It's gone up 40,000% in 35 years. And again, that's not like a company that's curing cancer or putting men on the moon or anything like that. It's just a retailer. And that thing goes up 40,000% in 35 years. You know, not 20 years, but a little longer. And you probably saw my video of the top stocks in the history of the world, basically the total return in compound annual growth rate since IPO. And number 1 on the list is Tesla. Number 2 on the list is NVIDIA. Tesla has a CAGR of 48.53% since inception. NVIDIA, 40.62%. But NVIDIA's been around 11 years longer than Tesla. Remember, the years on the market is very important to look at. And of course, you got Costco there as well. Average CAGR, 15.99%. So the CAGRs, I like what you're coming from with this, with a very conservative CAGR and a high index rate. But me plugging the numbers that I expect, my bear case for Tesla, but there's a twist to this. We'll get to the twist in a second, using the retire model. 24 shares at a 35% CAGR will get you to $3.198 million in the year 2045. Again, that assumes 35% CAGR. It's very big, but we don't know how long the CAGR will stay there for. For some companies, it stays there for 30 years. For others, we don't know. But definitely going out 10 years, you can assume a 35% CAGR for Tesla. Probably, unless something really bad happens, which is also possible in investing. But what we're going to do as well in version 2 of the retire model, we're going to add a CAGR throttle, the same thing I use for my price prediction models for Tesla, which means you can assume an initial annual growth rate of, say, 40%, but then after a certain period of time, you start throttling it back. So you got your 40% CAGR, but after X years or after the first year, you start throttling it by 10%, 12%, 30%, whatever it means. And we're going to refine that as well in the model that'll help you direct it. But again, congratulations. You're 25 with 24 shares. Get to 25 shares and add 1 share a year. And that should be your focus. I always talk about 300 shares, but you're so young. It doesn't matter. You have what everybody my age wants. You have time on your side. And when you get older, you'll realize how important that is. So congratulations. Thank you for the question. Next question is from Jackro. Hi, James. You've always emphasized concentrated bets, get in early, get in hard, and a small number of high conviction assets because deep research and tracking become tough beyond 4 to 5 core holdings. Very true. With the IA9 list now at 9+ companies, you're considering adding if the price is right. How do you plan to maintain that high conviction concentration without diluting your typical setup where a few assets dominate 90% of the portfolio? And which of these IA9 stock picks do you currently see as having the biggest potential to become major holdings, i.e. 5% allocation? Very good question. And this is very important as well. But because I'm in certain assets very early, like Tesla since 2017, it's going to be very difficult for anything to touch that portfolio. There was a time, only probably a year and a half ago, where my Bitcoin position was basically the size of my Tesla position. But that has all radically changed because of a little bit of rotation, etc. But now, these are my approximate allocations between what I call the two big narratives with some other things. You know, you've got some stuff in there like SE out of Singapore and some STRC, etc. But these are my approximate goals. So to be 66%, 2/3 in AI right now, NVIDIA, Tesla, plus Baba and a few other little ones, but very heavy concentration. Basically, of that 66%, Tesla is a huge chunk. NVIDIA is a chunk too. And then crypto, you got your Bitcoin, your Sol, and your proxies. I have proxies of obviously MicroStrategy and other Sol proxies too. And Bitcoin miners are included in crypto as far as I'm concerned. This is my goal. Also, I've been stacking cash for the last 6 months, ready for some type of market dip. Now, people ask, but why are you not majority crypto? Well, as I've done in many videos, I have shared the total addressable market of AI versus money, or Tesla versus Bitcoin, whatever way you want to skin it. The total addressable market of things like AI and robotics and autonomy from Tesla are far bigger than the total addressable market of money, wealth management, Bitcoin, etc. And I chase the TAMs and I chase the companies that generate the most profit from these TAMs and have a dominant position. It's all very simple, the approach, but it works, and it's worked for a long time. And that's my angle here. So I will still have extreme concentrations, but I'm looking to deploy. You know, it's all about, we'll get to another question that answers exactly how I set up traps, and that determines how much I buy and when I buy. Very important. So for example, we'll get to it later, if Tesla takes a dump and goes down to 300 and everything else kind of remains equal, the cash will go into Tesla. If NVIDIA goes back to 88, the cash will go into NVIDIA. If AMD drops to 120, the cash will go into AMD. That's kind of the way I do it. I let the market decide how I allocate. But these concentrations will not change. It takes a lot to modify the actual portfolio. Next question is from S22. Hi, James. I'm stacking Tesla 50% and Bitcoin 50%, and my plan is to do this until 2030, 2032. With the CAGR of Tesla being so high, why should I bother redirecting some funds to other AI stocks? Brilliant question. Also, this ties directly to how I answered the previous question, but I do want people to understand this as well. These are the 3 pillars, the 3 timeless truths. And again, I have very heavy concentrated bets in winning assets. That's kind of my gig. I know for a fact, if you have 60 different assets, your returns will suck. They suck. But if you can excise 4 or 5 winners, and even 3 winners, even 2 winners, and they are winners, and you time them right, and you rotate and do all that fancy stuff, and you sell options and cover calls, you make a killing. But I do want to stress these two. Diversify. Never be all in on one asset. Any asset can blow up and go to zero. And I am already very heavy NVIDIA and Tesla with extreme leverage, as you all know. Also, you DCA in, or DCAS in, as I like to say, at appropriate times. Bargain times, and you're patient. You wait for those. And remember as well, always keep an eye on things. Your thesis can change. We don't know if Tesla or Bitcoin will be around in 2030. So always have your tap dancing shoes on. There could be a double spend problem. There could be a fight within the development community of Bitcoin. There could be a quantum risk, although I don't see that happening for another 8 to 10 years. It'll be quantum proof by then. But the point is, you have to be ready for what could come. There could be a Tesla killer out there. I don't see it because they themselves are a 12 line of business company. So it'd be hard for them to do certain. But please remember those time and suits. Never be all in on one asset. Going fast, we've a lot to get through today. Next question is from Vex Z. Following your teaching since 2021, woohoo, from the beginning. Needless to say, thank you so much for being a mentor. Thank you. As AI advances and eats away at human-driven jobs, I fear people will take it into their own hands to voice their unhappiness with the new technologies. For example, living in LA, I remember people trashing the electric scooters the first time they came out. It's something particularly easy to do since there isn't a human to police that. And do you think a similar thing could happen with robotaxis? If Tesla replaces hundreds of thousands of human drivers in a few years, it feels like an inevitable thing. What are your thoughts? Well, I love the way you think because you're focused on risk. And we do have history. That's why I love history, because you can look at what happens during such disruptive times like this. And I'm going to go through a lot of history, 200 years worth, in fact. First of all, we had New York City versus Uber. The taxi drivers have a lot of power over the politicians in New York City. And the taxi drivers, I remember way back when I first landed there in the early 90s, they had these medallion things. And the medallion would cost sometimes $250,000. And that medallion is the right for a year to actually drive a cab or something crazy like that. That's how much they pay. That's kind of how the monopoly was controlled. And they fought tooth and nail to ban and block Uber from going to airports because airport runs are very lucrative and all that type of stuff. Anyway, eventually that all passes over time. There were some things they had to change for Uber in New York City, but anyway. London, England, shout out to Team UK. They had a huge Uber taxi protest, and also other parts, I think the Netherlands as well had one, and it brought traffic to a standstill. Nobody likes change, but eventually you can't really stop change. Let's go back in time a little more before we get back to scooters. The Luddites, also in the UK, I think, early 19th century, textile workers. They smashed all the mechanized looms because they did not like these looms that you wind with your hands taking the manual jobs of, I guess, creating textiles. Very interesting. So again, this happens over and over and over again in history. And then, of course, we did have the electric scooters in LA that you mentioned. They were the dockless scooters from Bird and Lime and a whole bunch. Residents hated them. They were set on fire, thrown in the ocean. It was terrible. And people didn't like them. People didn't like people spinning around the city in them, cluttered sidewalks, all that. So there was a revolt in 2018. So it's just natural. There is a difference, though, with Robotaxi. Robotaxi has 8 cameras, so it records everything. If you vandalize one, there will be images of you. And even if you have your face covered or whatever, it'll happen and you'll be found. And hopefully prosecuted to the full extent of the law. I'm not one who likes crime. I just want to be perfectly clear. Certain things I don't like. I don't like crime. I don't like violence. I don't like that type of stuff. So hopefully there will be laws in place where they are prosecuted. And Tesla will be very careful about deploying in cities where there won't be, call it, that level of damage and vandalism and stuff. It probably will happen, but I think it'll be few and far between, because in history suggests that everything will be fine. People will get used to it. They'll like the cheaper rides. They'll like the reduced congestion. They'll like the safety improvement, like the customization of the music in the car, all that stuff. Being alone. there'll also be lots of new jobs in fleet maintenance and remote monitoring that will offset a lot of transitions. And, either way, we've gone through this before. Yes, it'll be painful. We are fortunate as well to have Waymo leading the charge. Nobody's bothered by Waymo cars until there's a riot where they burn 4 of them in the same day. But again, that stuff can happen. But to Waymo, they cost 180 grand a pop. If you burn a Robotaxi, it's like $15,000. So things will happen. Change causes pain. We know that. You're dead right, but it's not going to derail the future of the business by no stretch of the imagination. So thank you for the question. I like the way you think. Next one, Midwestern Squirrel. Thank you very much for your hard work. IDSS helped me so much to be patient and much improve my trading results. Fantastic. Always use the backtest and always dial it in and your timeframes. My question is about Microsoft and Meta. As a part of your 2030 Mag 7 predictions a few months ago, it was nearly a year ago, are they still in your Mag 7 list for 2030? I'm asking because with AI, Microsoft and Meta could be replaced by other platforms, especially Microsoft. So I've been saying for quite some time that the Mag 7 will be disrupted. That's actually one of the reasons why there's a thing called the IA9 now as well, which we'll get to in a minute, because there are some big changes happening in the world. And first thing you have to understand is the rate of change of things changing in the world is rapid. Just like maybe scooters being littered all over a city in Los Angeles in 2018. So let's get into one of the big changes. First of all, AI agents are going to eat software. Mark Andreessen famously said 20 years ago, software is going to eat the world. Well, now AI agents are going to eat software. It's a crazy food chain out there. And we know people like Elon Musk is going to go after Microsoft, which you mentioned. He wants to simulate software companies like Microsoft purely with AI. And he calls it macro hard, play on the term Microsoft. I've made a number of videos about this. But he believes since software giants don't produce any physical hardware, their operations from coding to management can be easily replicated by AI alone. And XAI has already filed a bunch of trademarks for MacroHard and is hiring some of the best developers in the world as well to do exactly that. So whether you have an ERP or a CRM system or a data intelligence system, it's going to be very easy for AI and AI agents to replicate what you have, which will be shocking. Also, there's other stuff happening behind the scenes, which would make me very nervous about Microsoft right now. OpenAI years ago, I can't remember when it was, 2015, 2016, 2018, was created to be open, a non-profit company to serve as a counterweight to Google. But now it's closed source and it's for maximum profit. And it's effectively controlled by Microsoft as well. And that's not what was intended for OpenAI. Now, there's a lawsuit happening, and he claims his early money, his work, in building the team, etc., helped build a $500 billion company. And now there's a court case, and he wants to sue $79 billion to $134 billion. And of course, Microsoft is on the docket because they are partly in control, or some people believe majority in control for OpenAI. So this is going to be literally, I'm not one to be that interested in lawsuits, but this will be one of the moments where you get your little popcorn and you just watch it, because the juice that's going to come out in the discovery is going to blow your mind. I've seen some of it already. It's very exciting. And there is one guilty party. One. Anyway, other things. You mentioned Meta too. I touched on this. Meta changed their name from Facebook to Meta, and then killed Meta, killed the Metaverse, and they laid off 1,500 people behind it. And it cost them $73 billion, which with that, they could have bought over 10 million Bitcoin, if I recall. Imagine saying, we're not going to invest in the Metaverse. Instead, we're going to build a bag of 10 million Bitcoin. MicroStrategy nearly have 700,000. They've been stacking like mad. That's how much they wasted and flushed down the toilet, which is shocking. And it's like General Motors and Ford and doing huge write-offs. It's just all accounting. It's like, okay, we made a $25 billion mistake, a $74 billion mistake, a $19 billion mistake. Sorry, move on. Nothing to see here, folks. It's just crazy to see. I hope there's a reckoning. It's like AJ's chart where he shows you the amount of free cash flow generated or burnt over the life of the company. Those charts are golden. Remember, at the end of the day, free cash flow is everything. Okay, back to Meta. Why Meta could be in trouble? They are committing to invest 50 billion, 600 billion, etc. in infrastructure for AI, nuclear power centers, hiring a whole bunch of partners, wild expense. They should not invest that much if they're not going to win the AI game, because my other key principle in life is winner takes most. Okay? Tesla, XAI, Tesla have their own huge data centers too, but XAI now have a gigawatt data center of coherent compute running, and by April it'll be 1.5 gigawatts. Nobody else on the planet's even close, nor can they get there, because now we're seeing memory shortages and electricity shortages and everything else. So again, winner takes most. If Meta drops into the 50 billion, 76 billion, 100 billion, 600 billion, it's probably going to be like a flush it down the toilet metaverse scenario. And that's the way it is. Now, back to bigger picture software. Many believe AI is going to eat software. Of course, we know software is going to eat the world. But basically, you can conclude that AI is going to eat the world. And that's why, since 2022, I've been talking about that. It's coming. Now, software companies over the last 10 weeks, you already see the cracks. Okay, Mag 7 is down, but remember, you have to look at Mag 7 not as a group. It's like the S&P 500. It's 60% zombies. It doesn't matter. But some of these software companies are already showing a lot of cracks. Meta down 13% the last 10 weeks. Microsoft down 10%. Netflix 26%. Let me see. Other ones. Salesforce down 8%. ServiceNow 29%. Oracle 37%. I mean, Adobe 10%. Well, I can't read any of those. Palo Alto Networks down 8%. I do have a position in Palo Alto Networks. I need to look at that. But that's more on the security side. I believe security will be one of the safe ones. But the big bright spot here, of course, is Google. Google are one of the players of the Mag 7 that I'm actually very confident in. Tesla, Google, NVDA, they're going to be fine. But the rest, they could be disrupted by AI and AI agents. So that's the skinny. Everything's a moving target. The world will look very different in 3 to 5 years. Buckle in, because the shark is coming, for sure. Next question. Hi, James and team. I found this channel 2 months ago, and I love it. Ooh, you're new, Oystein. Thank you. Now, this is a very clever question. I'm worried about silver and its impact in the world right now. Demand is greater than ever. It's used in batteries, solar panels, electric vehicles, electronics, and everything is hot right now. Here in Norway, silver is mostly sold out in the stores. Could silver be a bottleneck for Tesla and other AI plays? Seems like the world's silver production doesn't fill the demand from the AI race. Also, my guess is that China don't want to export theirs to the US. Again, I love the way you guys are all looking around the corner. Very important. I'm going to answer this very simply in 3 parts. Number 1, yes, there is a big squeeze. There is a shortage. A couple of points that we've all learned over the past year or so is it's the 5th straight year where demand outstrips supply. Shortfall of 150 to 250 million ounces. No idea what an ounce is in grams or kilos, but it sounds like a lot. And spot silver is now above $90. So all the silver bugs. I used to trade silver as a range rider between $22 and $27.50 for years. It was a beautiful range rider, and then just gone. Anyway, don't have silver. But China did also implement export controls. Okay, just like they're trying to do with their rare earths and other precious things. Remember, scarcity is important. They tightened their export controls to just 44 licenses, and they're focusing on their own domestic industries first. Guess what sucks in a lot of silver? It's not EVs. It's not batteries. It's not semiconductors. It's solar panels. Solar panels suck it all in. And that's where most of this supply is actually gone. And the Chinese, of course, with their 20-year planning, they knew that was coming. So silver is no longer just a commodity. It is now a strategic metal, like rare earths, like copper, like gold, etc. So you are dead right there. Very, very important. Let's go to part 2. Is Tesla and AI at risk? The answer is, well, if you look at a Tesla vehicle, to calculate this, it uses about 25 to 50 grams of silver for battery management and performance electronics. That's like $100, $200, somewhere thereabouts. Not a lot. Not a lot to be concerned about, considering the battery pack used to cost $10,000. So the battery pack is a lot more expensive than the silver components, but it does add a little bit, but not enough to keep you awake at night. High performance GPUs, yes. Switches, yes. They also rely on silver, but again, nothing near the demand for solar panels. Solar panels consume about 20 to 25% of global supply right now, and that's where it's all being sucked up. That's creating solar panels to create free energy, which is also another big bottleneck that's very scarce as well. So in my opinion, it's not a threat, but it could impact margins ever so slightly. And if, for example, imagine Elon wants to make 2 million Robotaxis real fast, or 1 million Optimus robots, and they require silver, they need to make sure they tie up that supply chain early to be able to scale. So that could be a slight bottleneck, but nothing that would keep me awake at night. There's far bigger concerns right now. Final part, and with anything in life, people say, oh, we're running out of electricity, oh, we're running out of gold, oh, we're running out of silver, whatever. Humans are very innovative. And if there's money at the end of the rainbow, they'll dig for it, they'll find a way to make it happen, etc. There's a couple of things that are happening right now in the silver world. One, obviously, scarcity is always a catalyst for progress or innovation. And solar manufacturers have started finding new ways to create panels using 85% less silver per panel. Also, EVs are replacing silver with copper and nickel-based composites. By the way, nickel has gone to the roof as well, probably because of this. And recycling is happening. It's at a 12-year high. So there's silver in a lot of stuff. There used to be an old quarter, 25 cents piece in the US. Like 40 years ago, that was mostly silver. And then they've replaced it with nickel. So again, there's probably a lot of silver out there lying around that you can find. And high prices unlock things that were impossible in the past. You know, it's like the supply cavalry comes in when you can find oil in sand up in Canada. When oil price goes high, they just dig a little deeper or find new ways to process stuff. Also, there's a new silver mine coming on called Endeavour Terraruna. They'll bring in about 9 million ounces in 2026. And this is all basically what they call the Malthusian rebuttal. Okay, whenever something gets expensive, people find a way around it. So thank you for the question. Don't sweat silver too much. It'll be fine. Next one is from British Petroleum 03, BP03. Hi, James. I'm curious to know you're waiting for IA12 plays. IA9 has become IA12 because we added a few things that fell into our traps. I know you'll only enter a position if it falls into one of your traps. However, I'd like to know what names you will go in heaviest. NVIDIA, Broadcom, AMD, etc. if the opportunity presents itself. Thank you for leading this wonderful community. Thank you too. And again, this goes back to the previous questions. It's all about relative value and layers and stuff like that. So first of all, I call it my trap house method. Okay, the lower they go, the harder I go. Balancing relative value versus upside potential. It's so important. Hang on, the dog is barking. Somebody, go get the dog. Now, I also use things like layers on ATR, the augmented trading range model, to determine exactly how and when I go in. Let me give you a classic case in point. And by the way, I am absolutely patient. I will wait, and I will wait, and I will wait, because I don't chase, and I don't like overpaying for assets. But there's a couple of key lessons here. First of all, these are two charts. On the left, you have AMD. On the right, you have NVIDIA. When you look at, again, they're both on the ATR model on the daily chart. You look at AMD. It is at $231.83. All-time high is about $265. Would I buy here? No. Is it going to mean revert? It could. Could it go to the moon forever? Possible. But when I look at what happened to NVIDIA back in April 2025, As you all know, I bought heavy twice in one day at the $88 level. I like the number 8. That was bang on layer 3 on the ATR model. Completely fell out of bed. And it was a perfect opportunity to pick up a bargain at rock bottom prices. Okay, that was layer 3 on the ATR. For AMD to hit layer 3 today on the ATR, that'd be $120. Currently $232 is basically double. So do I buy at $232? No. Do I nibble at layer 5? Maybe. It depends what else is cheap out there. Do I buy at layer 4? Probably. Layer 3? Yes, I go hard. So this is exactly how I approach anything. Now, because I'm looking at traps across many assets, and I've got cash in the sideline to deploy, whatever falls into the traps, I buy. And now there's like 12 different assets, including maybe Bitcoin if it falls to 70K. That's juicy for me. Solana at $100, that's juicy for me. All the traps are laid. The markets will determine what I buy. And I buy based on relative upside, relative value. Where is it going based on my price prediction targets? And remember as well, for those of you who are itching, you got a big pile of cash and you're like, oh, I really need to buy something. I feel I'm not being a productive human unless I buy something this week, or I'm going to get really fancy and day trade and everything else. Be patient. The less you trade, the more you sit on your hands, the more patient you are, the more you win. And that's what matters. Your ROI and your trade, absolutely critical. There is always a trade to be made. You just need to wait for it, okay? Please, everybody, learn to be patient. Most important skill. And it's a skill I learned from Warren Buffett. I hope he's having fun in retirement. Next, from Iron, I am deep diving into the world of options. My mind is getting blown away, and my learning curve is going vertical. My question regarding leaps, after analyzing your trade alerts, I've noticed you sometimes buy different strike prices for the call options you bought and the put option you sold. Sometimes you choose a different date to expiration with the same combination. And I wonder what your thesis is for this. Shout out to GQ Trader Josh and Jacob for sharing their knowledge. So this is very important. A lot of the time I've been trading options for like 35 years, so I can look at a huge page of different strikes, puts and calls for assets, and I can immediately tell in my head which ones are mispriced. So a big part of it is identifying things. If I'm selling something, it's expensive. If I'm buying something, it's cheap. And the perfect combo is to sell something expensive and buy something cheap at the same time. Okay, that's what I call market pricing inefficiency. Then there's the break-even point. You've seen some of my trades, for example, of late with the IA9. I basically put a combination together where the break-even for the trade is pretty much the price we're at today. And that's another way I look at it too, is to maximize or minimize my risk and have a very low break-even point on the trade, especially with options. I also want to minimize my cash outlay because I got tons of margin. Okay, and I compare that to the future price prediction. So if I'm doing a strike leap of $100 and my price target's $350 and the cost is like $8 for the position, that's going to be a juicy ROI if I can get there in 1.5 to 2 years. That's what I look for. And my end goal is always to maximize ROI with the minimum amount of cash in the game. And the time frame of the trade as well, when I want to be out of the trade or when I believe the asset will top, or when I believe the price target will hit. Very important. Very important. Okay, hope that helps. And it's tricky, but you'll get the hang of it after a while. Next, from Papa Crypto, I'm thinking out of the box. What's your opinion on Parker-Hannifin? They primarily make materials used in aviation, space, and other sectors, and has done very well for me since I started investing during COVID. Could it be part of the IA9 as a supplier or diversification in a portfolio? So when I put the IA9 together, it was very much focused on AI and all the winners in AI out to 2030. Very important. This is what I'm looking for in them. Hypergrowth through 2030, very low debt, very profitable, and a very inexpensive valuation. It's like buying a diamond for the price of a piece of coal. It's what I look for. It doesn't always happen, but you can find those treasures. Now I look at Parker-Hannifin, there's a couple of things I don't like. They don't have hypergrowth. In fact, going back to 2022, the growth has been the same. Their net income has been the same. The EBITDA has been the same. Their debt is growing. They got very little cash. That disqualifies it for me. I don't even have to look at a chart. I look at the financials first to see if it qualifies. Now, the next quarter, they could make $1 trillion on a sale. That's 90% margin. I don't know. But this is enough to tell me I'm in much safer assets. And related to this is another question, too, from Kukin. Hi, James. Once again, thank you for what you do. You've pointed out many potential AI plays. But one company you rarely mention is Dell Technologies. They have a thriving data center, server storage network business, even before their acquisition of EMC a few years ago, which only made them more dominant. They have pivoted heavily into AI and have significant partnerships with NVDA selling AI compute. They also have reported a partnership with xAI, supply AI infra for Grok, plus Michael Dell is a huge Bitcoin bull, so he knows they could eventually start adding Bitcoin to their balance sheet. Thoughts? I do like Dell Computer, especially with their pivot. I remember I used to trade EMC back in the late 90s as well. I know, and Dell Computer, I used to have Dell laptops and Dell computers at home, so I know the company very well. But again, it has a couple of things I don't like. So just looking at the hypergrowth, it lacks that. Profit is pretty much the same as it was in, say, 2017. And their debt is high, although it looks like they've been paying it off over the last couple of years. But it's still too high for me compared to cash. And if there is any type of crunch, anything to falter in the whole AI space, and there will be AI bubbles, there will be casualties in 2026. We just don't know their names yet. But when those casualties hit the wall, the whole space will fall. And that's what you got to be afraid of. And the IA9 are far superior to Dell. I compared everything to everything. And again, it lacks the hypergrowth and it's too much debt. Great company, but doesn't meet my qualifications for upside through 2030. And next question is from PW. I like that. Hello, James. I'm deeply grateful for your work and passionate about helping us. I heard Chamath on the All In podcast make a contrarian prediction that Elon will do a reverse merger of SpaceX with Tesla rather than proceed with SpaceX IPO. What's your take on the probability of that and how that might impact Tesla's stock price, positively or negatively? So there are some people that are very smart, and 80% of the time they say very smart things, but 20% of the time they don't. So when I first heard this, it's like, oh, Chamath, come on, what you do? Come on, wake up. Let's check out his record at space. He's not good at space. He did a SPAC with Richard Branson here from Virgin Galactic. Shout out to the Brits once again. And the SPAC is down 94%. That didn't work. Maybe it's a dream to get a revenge trade to get some money back out of space. I don't know. But there's 3 reasons why I think it'll never, ever happen in a million years. First of all, antitrust hell. They've become a huge target. Okay? There will be the most insane scrutiny. Okay, the merger would create a $2.5 trillion, $2.6 trillion behemoth, dominating EVs, energy, space, telecommunications, etc. You will have the FTC, the DOJ, everybody crawling up your butt. You'll have Europe crawling up your butt, etc. It would just be a nightmare, freaking nightmare. Also, national security risks. SpaceX is working with the military for defense applications. Okay, and there's extreme security and controls around that. I can't even imagine how deep they are, but merging with Tesla, a global manufacturing company with factories in China, etc., factories in Germany, would complicate security clearances and federal funding. It would just not happen. And then your infrastructure monopolization. Regulators would view the integration of satellite tech and autonomous transit as a threat to competition that nobody can compete with. So it would be called a monopoly and it would be shut down. So, yeah, never going to happen. And that's just point number 1. Point number 2, okay? Imagine you're a bag holder. Imagine you're Peter Thiel, big bag of SpaceX, probably a big bag of Tesla too. Conglomerates suck. Look at the big conglomerates in India, okay? The sum of the parts is worth more than the conglomerate. Always remember that. Or is it the sum is less than parts? Yeah, the sum of the conglomerate is less than the parts. Sorry, I got that mixed up. But it would be dilution disaster. Okay, SpaceX 1.5 trillion, Tesla 1.5 trillion. Would need massive amounts of new stock, dilution. Shareholders would have to take a 50% in the shorts, tanking share price, etc. Then you get the conglomerate discount, because that always happens. Markets reward pure play companies, but penalize empires. Look at GE, look at Tata in India, etc. And blending Tesla's cash flow with SpaceX high burn to Mars mission would be a disaster. Also, shareholders would lose their frickin' minds. They would resist, absolutely resist this, because they understand conglomerates suck. And that is kind of what I believe would be a huge shareholder revolt. You don't want this to happen again in a million years, ever, for so many reasons. But there's a third part as well. And it proves it. Operationally running these things would make no sense. Tesla is a consumer-facing entity driven by quarterly earnings. SpaceX is R&D heavy, private firm, focused on multi-decade goals. Forced transparency would stifle SpaceX's fail-fast innovation model and many other things too. Also, synergy versus reality. There is a lot of synergy of these companies together, but they're not required to own each other. They can get that synergy by sharing stuff. For example, I do believe all the comms for Tesla vehicles will come from SpaceX in the future, not local carriers. And the best path remains a standalone SpaceX IPO. Sometimes people, have other interests to pray for such a deal, but the baggage of such a merger would be insane, stupid, never going to happen. I'll bet anybody $1 million on it. That's how confident I am. Next question is from Clayton90. I've noticed many alts since mid-2025 are on huge sale. Think of dexes like Drift. Upgrade V3 is amazing, sleek and fast. Jupiter, Aster, Hyperliquid. Are they still interesting opportunities to invest in the current economic situation? So we had a sad situation in 2025. And that was the black swan of 1010. 1010 changed everything. It kicked a lot of people in the teeth. It made people who are kind of risk averse say, I'm never touching that shit again, because the market makers and the oracles, etc., are all there to shaft you. And there's nothing you can do about it. Okay, so that has absolutely poisoned the bed for many people on Perp Dexes. However, there's a couple of things that are kind of interesting is, despite the market manipulators, hopefully there'll be clarity around that with some legislation that will prevent them from doing their games. But Jupiter now is doing more around tokenization of stocks and prediction markets. And they are making money hand over fist. And looking at the 2025 revenue, Meteora made 1.25 billion, Jupiter 1.11 billion, Pump.Fun 937 million, Hyperliquid 909 million. These things make a ton of money. So I still have my little positions, but remember, allocations matter. They're tiny positions. If they went to zero, I wouldn't even notice. So remember, if you are investing, balance your risk and reward. Be heavy in things. They may not be the fastest horse, but if you get 35% CAGR over 10 years, that's as fast as you ever need, as we illustrated today. Always balance risk and reward. You can throw a couple of peanuts as these little flyers for giggles. Maybe you 2x, 3x, then take it. Take your money and run. But do not put your future in the hands of crypto like this. You're not in control. Very dangerous. But you can have a flyer. Again, always far less than 1% of your portfolio. And finally, best part of the week. Helping friends. This week we donated to the Friends of Bonobos to help support their mission to protect bonobos in the rainforest home in the Congo. Awesome. And they're so cute. I've always wanted one. Anyway, and tomorrow, Rob is back on DCA, woohoo, and he adds a very interesting perspective to the team. And grateful Mando is off in a plane again. He likes his airplanes. And hope you all learned something. I'm going to do some live questions right now. But that was the compounding miracle. Be in the right assets. Again, allocate carefully. Allocate so carefully. Allocation is the edge, and disruption is your opportunity. And yes, AI is eating the world. Remember those three things. First question from I Am Cult. I have half of the Tesla share goal. Are there strategies other than DCS to acquire the holy 300 mark? DCS and sell cover calls against 100 of your shares. Do it when I do it. And then you can slowly build a bag pretty fast. You can generate a lot of cash on the side to buy shares. And you can even put that cash to the side and then use that to DCAS into Tesla on dips. That's the best way to do it. Excuse me. Charles Kincannon, with custodial accounts such as Fidelity, where do you see the risk of either the future U.S. government confiscation or security within the platform? I think if the U.S. government messed with a place like Fidelity or Schwab or BlackRock or whatever, they'd be putting a pin in the whole faith of the U.S. government. So, they could technically, if you were a bad actor, imagine you're a fentanyl dealer or something bad like that, and they knew you had all your Bitcoin with Fidelity custody, yeah, they'll be able to reach in and grab it. But if you don't break the law, you're going to be fine. So, again, if the government was to pierce the veil of something like Fidelity, all trust would be lost. All trust. And you can't replace trust. Fidelity has built up trust over many, many decades. Happy feet. My best friend's son is in his second year of his electrical apprenticeship. He was just accepted to university for electrical engineering. Which one would you do? It's a tough one. We know that there's a huge demand for electricians right now. And apprenticeships are tough. You got to work real hard and get nothing in return. University for electrical engineering, it could be a good skill, but if look at it this way, if he has to go to university for 4 years and he has to invest, like he's got the opportunity cost of not being able to earn, the cost of education, I don't know how much that costs up there in Canada, you have to trade all that off. Also, how good is the school? Because your degree is sometimes only as good as the school it comes from. If it's a top tier school with great reputation, and then you can position yourself maybe within, a big tech company that needs that type of electrical engineering capability, go for it. I actually have a very good friend who is an electrical engineer, and he became a software salesperson, and he's very successful. So very successful. I guess he sells AI data. Think about that. From electrical engineer to selling AI data, making a fortune. So you never know what's going to happen, but I would weigh up very carefully the opportunity cost of going to university today and how much you can learn using AI. If he's smart enough to know what he needs to know and the right questions to ask, I think he can spin up a better business on his own, especially with the build out right now. And if he's proximate to locations that have a demand for his services, he could make a complete killing. I mean, there are electricians earning $240,000 a year now in data centers in the US. $250,000. Not bad. If he's an electrical engineer working at a Siemens or one of these players, he's probably not going to earn that much. So think about that. Think about the 4 years and the next 4 years and how important it will be. But I'd need to know how much it's going to cost him to get that education, how good the school is too. And thank you for your super sticker, Buckhorn, Nick, B-Man, KT, AZ Rolfer, Swiper No Swiping. You all rock, my people. Thank you all for being here. And shout out to Sean D and K8 and everybody for being here. Happy Sunday. See you all tomorrow morning for DCA Live. That'll be spicy. By the way, I didn't even check the Bitcoin price because sometimes on Sunday it pumps. It's gone up $300. Nothing big, but thank you all for coming. See you all tomorrow morning. Bye-bye.